Now, looking at your top line numbers, we saw quarter-on-quarter growth slow 2.3%, while we saw year-on-year growth up 14.7%. Now, Q1 certainly looked better, but we know it was boosted by a one-off event. Analysts certainly aren't complaining. They think your Q2 numbers look great. They're satisfied with your numbers. Now, they say the results should reflect the economies of scale that should be coming from greater volumes at your new plant. So we're also seeing a downward trend in soft commodity prices. So, I mean, give us the whole picture. What is really the story behind your numbers when we put all these factors together?
Thanks, Uche.
Yeah.
Well, first of all, the quarter-by-quarter result, actually, you should look at in perspective. We're actually, if we have around 2.2 billion naira worth of business which was pumped into the first quarter, which we actually declared during our announcement in Q1. So if you look at it like for like, we're about 22% growth on Q2 versus Q1 and 27% growth versus year on year. So business is in good shape. The additional business that we pumped in was, in actual fact, to do with some internal adjustments as we moved to a new distribution centre. And obviously then we're juggling around with a little bit our figures there and our stocks, but that's even levelled itself out. So yeah, we're in pretty good shape in terms of the actual performance quarter to quarter.
Well, it's hard to ignore the fact that your operating expenses were up about 39% year on year and 19% quarter on quarter. What is really behind this? We do know that, of course, the issue with the situation in the north and security, that has impacted FMCG companies quite a lot. What really is behind this?
Yeah, first actually 39, I think you might be slightly mistaken there.
Right.
The cost of sales, or the cost, the actual is 30% there,
Okay.
and 27% of course is explained in the actual natural growth of the product. So cost of sales is up 27, volume is up 27, cost of sales up 30. The part of that variation is in the mix as well. So we're an annual business, we're running annual promotional activities, and the mix of the business will level itself out a little bit as we go through the rest of the year. And if you look also in our, because the other factor you're looking at there is the actual cost of running the business, which actually has decreased. I mean, we're actually running at our sales, distribution and admin at 16% increase versus this time last year. So very, very much under control. In terms of raw materials, you mentioned in the north, I mean, yes, of course, there are some variations, but we're actually offsetting a lot of that with other cost-saving initiatives.
Well, you just talked about in terms of raw materials, we know agricultural commodities internationally are going up, but you know, Nestle really sources its raw materials here locally. But I mean, we can't argue that things here are not much better. Here in Nigeria, where we have insecurity in the north, like you just mentioned, subsidy removal, of course, power tariffs are going up as well. How are you managing costs? I mean, with all these factors.
Well, managing costs for us is a bigger issue. I mean, at Nestle globally, there are two things. First, we're constantly refreshing our business with what we call NCE, Nestle Continuous Excellence. This is a program of really getting work from the bottom up of the company where the people know best. So we have excellent people and they know best how to save the company more money, if you like, if you put it into dollars and cents. But it's the pride of doing the job better, and do not underestimate the savings that can come from day-to-day efficiencies and running the business in a better way. So we're very, very, let's say, cost conscious or focused, but it's more to do with improvement. It's not about saving money for the sake of saving money. It's just saving money because wherever there's redundancy, we want to eliminate that. So that sounds a little bit blasé as an answer, but the truth of the matter is that really is a significant factor in our efficiencies. Secondly, there's a volume. Once you have a certain volume, which we have in certainly very strong categories like Milo and Maggi, Golden Morn, these three big pillars give us great economies of scale. And as far as the north is concerned, actually, yeah, there was a bit of a slowdown, I'd have to say, in June. It was a very tough month. And yeah, that's becoming an impact. If Kaduna and other markets close down, that can be up to 8% of a company like ours turnover. So for every week, that's 2% of your business that can't come in, if it's closed up completely. So that's been challenging. And up to 32% of our business is actually impacted with all of the problems in the north.
Now, last time you were here, you did mention your export capability sort of increasing. In fact, you talked about bringing in about 1.7 billion. How much are we seeing that as a part of your bottom line this time around?
You know, again, it's not such a big part of our bottom line because it's really more of an opportunity to absorb fixed cost. So we don't see that as a major opportunity for bottom line. It's around 2% of our business so far this year, which is a nice increase. We've actually done nearly as much in the first half as we did all of last year. So we're continuing the momentum that we started. As I said before, without the export subsidy grants from the government's policies, we would not be competitive, given all the other factors that make it difficult to do business. But given the export subsidy grant, then we actually can have a pricing that enables us to export.
Now, one thing that, of course, analysts out on the Nigerian Stock Exchange floor want to ask you is why no interim dividend this time around? We do know that last time you mentioned because of some debt supporting some of your lending. What really are your motives this time around in terms of retaining that cash? What do you want to do with it this time around?
Well, we don't provide ever an interim dividend at this time of the year, so we only make an interim dividend towards the end of the year, as we've done in previous years. So it's not really a topic for discussion right now. So and again, in terms of our process of acquiring money on the stock market through shareholders or taking loans, and clearly we're having big capital expansion, but we're funding that through loans, and interim dividends have played a part in the past. But it wasn't interim dividend, it's total, and it's always about what the shareholder receives as a total dividend that counts.
Now, looking at closely at your numbers, I did notice that it seems your profit after tax was boosted by some tax relief. We saw your half one tax rate is at around 14.5%, corporate tax usually around 30%. Give us a picture of what's behind this.
Well, I think the most important thing investors probably want to remember is that last year we received pioneer status, and that gave us a big boost in Q4 last year, which was discussed. And we're now comparing this year with the pioneer status versus last year in the first half where we didn't have that. So if you took that factoring out, we would be more or less line ball the same profitability, around 14.6, something like that. So we're in, again, a path for producing the same profitability level as we did last year.
Now, big discussion going on right now, of course, when the CBN governor came out, really, he actually increased, the MPC increased the CR by about to 12% from 8%.
Yep.
Now, borrowing costs certainly are going to go up. We do know that you're a tier one borrower, so definitely people are happy to give you money. But how do you think this is going to affect your company and, of course, companies in your sector going forward?
Yeah. We're in a good position because we actually have assets that we can leverage from outside of Nigeria in terms of finance, and we're very lucky to be able to take US loans from Nestle funding, and that means that we can balance the repayments against those loans, obviously still in Naira. So the problem for us is the devaluation more than the interest. But we do have local loans, and of course 12% is going to cost more money. But it's always a balance, and particularly our structure of loans is in very good control. But you're right, it's going to make a major difficulty for some other manufacturers here.
Well, thank you so much for giving us sort of the inside scoop on what's going on with your numbers. That was Martin Woolnough, CEO of Nestle Nigeria, giving us a take on his results.